For decades, even centuries, the image of an investor in many people's minds was a man in a suit, shouting on a trading floor or making deals. Women were mostly absent in that picture, often by design. But fast forward to today, women are increasingly stepping into the investing arena, whether it's managing their 401ks, dabbling in stocks, or launching businesses. Yet, despite this progress, we still hear some stubborn ideas, like the notion that women are too cautious or not as savvy at investing. So, is there truth to the idea that women invest differently? And if so, could those differences actually be strengths? Let's unpack the psychology of women as investors, the myths, the realities, and the shifting culture around money and women. Women's cautious approach. It's frequently noted that on average, women are more risk-averse with money than men. What does that mean? Simply put, women often hesitate to put money into risky investments like stocks, and may keep a larger portion in cash or low-risk assets. Surveys have shown women hold a lot of savings accounts and are less likely to be in the stock market compared to men in the same age or income bracket. Part of this might be upbringing. Many girls weren't traditionally encouraged to dive into finance or taught about investing by their parents to the same extent boys might have been. So there can be a knowledge gap and, with it, a comfort gap. Additionally, women historically had less access to capital and lower earnings, meaning they might have felt they had less to lose and thus needed to guard it carefully. Think about it. If you're juggling finances carefully to make sure your family is secure, you might prioritize not losing money over potentially growing it with higher risk. Some of it is personality too. Risk tolerance varies person to person, but studies do indicate men, on average, report higher comfort with financial risk-taking than women. The cautious approach has downsides. If you avoid investing altogether or stick to heavily to ultra-conservative options, you might miss out on growth and not keep up with inflation. However, and this is a big however, caution can also have upsides, underrated strengths. Here's the twist. When women do invest, their outcomes are often surprisingly good. A number of analyses from brokerage firms and academics found that women's investment portfolios slightly outperform men's over time. The differences aren't huge, but consistently, women tended to earn, say, 0.4% to 1% higher annual returns in some studies. Why would that be? One reason is trading frequency. Men, broadly speaking, trade more often, sometimes chasing hot stocks or reacting to market news, whereas women trade less. Trading less often can mean you're not racking up fees or mistiming the market with impulsive decisions. Women are more likely to buy and hold, which is a tried-and-true strategy for long-term investing success. Women also often take time to research and understand an investment before jumping in, and once they form a plan, they stick to it. There's less ego in the game. You see fewer women engaging in high-progressive beat-the-market gambits or meme stock gambling frenzies. That steadiness can lead to solid, if not flashy, performance. I recall a fun anecdote. An investment firm once found that some of their best-performing investor accounts belonged to people who had forgotten about their accounts entirely. They weren't trading at all, so their investments just quietly grew. In a similar vein, because women are often more patient and not overconfident, a trait that can trip up investors, they tend to avoid dumb mistakes like panic selling during a dip or chasing fads. Of course, these are general trends. Plenty of cautious men and bold women exist too. But it's important to highlight that women's reputed caution isn't about capability. It's often a strategy choice that can yield positive results. Confidence gap. If there's one thing holding many women back in investing, it's confidence, or lack thereof. Studies show a persistent confidence gap. For example, when quizzed on financial literacy, women on average score slightly lower than men, but a big reason is women disproportionately answer "I don't know" to questions they're unsure about. They second guess even when they do know. Men are more likely to guess and sometimes guess wrong confidently. This dynamic plays out in investing. A woman might feel she needs to know a lot more before she's ready to start investing, whereas a guy might jump in with minimal knowledge and learn by doing, or feel he already knows, thanks to a dose of overconfidence. This isn't to say one approach is better. Plunging in without knowledge can lead to mistakes, but waiting until you feel 100% knowledgeable can mean never starting at all, because with investing there's always more to learn. The key is balancing preparation with action. Many women also have a bit of imposter syndrome when it comes to finance. Even successful professional women sometimes defer long-term financial planning to their husbands or male relatives simply due to the social conditioning that men handle the money stuff. If you never saw women investors growing up in media or real life, it's understandable to feel like a stranger in a strange land when you open a brokerage account. The consequence is that women tend to start investing later in life than men and invest smaller amounts. Time is a critical factor in investing. The earlier you start, the more compounding can work magic. So this delay in caution can hurt women's financial outcomes long-term, contributing to a wealth gap on top of the wage gap. Changing trends. Fortunately, the last decade or so has seen a blossoming of resources aimed at empowering women financially. You've got books like Smart Women Finish Rich or Girl, Get Your Money Straight, podcasts by female financial experts, and communities like Ladies Get Paid or Ellevest that encourage women to invest and build wealth. Ellevest is interesting. It's an investment platform founded by a woman, Sally Krawcheck, specifically to address women's financial needs and goals. They even factor in things like women's longer lifespan, hence need for more retirement funds and different salary trajectories. The fact that something like that exists shows the market recognizing that women want in on investing, but perhaps with a slightly different approach. We're also seeing more women in finance roles, more female financial advisors. Some women prefer working with a female advisor who they feel will listen without condescension. Social media has also opened up conversations. You'll find female finance influencers breaking down stock market concepts or budgeting and investing tips on TikTok and Instagram, reaching younger women where they are. And speaking culturally, Millennial and Gen Z women are often much more candid about money than older generations. There's a push to demystify money topics. Women are sharing salary info to fight wage gaps, and likewise sharing stock tips or talking about crypto or side hustles. The more it's normalized, the more confidence grows. Investing goals and styles. Another point of difference often noted is that women tend to be very goal-oriented investors. Surveys find women commonly say things like, "I'm investing to retire by 60 and travel, or to send my kids to college debt-free, or to become financially independent." Of course, men have goals too, but women more often frame their investment strategy around life milestones or security for loved ones. This can lead to a somewhat conservative asset allocation because if your goal is security, you may avoid super volatile bets. But it can also mean women stick to a plan because it's tied to something deeply personal, not just a number for number's sake. That emotional connection to a goal can actually keep one focused through market ups and downs. Also notable is interest in ethical investing. Many women, and certainly not only women, care about the impact of where they put their money. ESG, environmental, social, governance investing, basically funds that consider things like sustainability, social justice, diversity in companies, has a significant female investor base. Women sometimes view money as an extension of their values and want their investments to align with making the world better, not just making profit. With more ESG funds available, it's easier to do now, though critics might point out those funds can have higher fees or not always stellar performance. Still, if it engages someone in investing who otherwise wouldn't, that's a net positive for getting started. Overcoming barriers. So, if you're a woman or anyone really feeling hesitant about investing, how can you take the leap? First, knowledge is indeed power, but you don't need to be an expert to begin. Start with the basics. If you have a workplace retirement plan like a 401k, that's investing. Contributing to that is a fantastic start, and you often don't have to pick stocks. You can choose a target date fund or an index fund. Many women are actually investing without realizing it through these routes. If you want to go beyond that, consider starting with index funds or ETFs. They give you broad market exposure and are recommended by famed investors for being effective long-term with low cost. You don't have to time the market. You can set up an automatic monthly contribution, dollar cost averaging, and slowly build wealth without stressing daily. This kind of systematic, patient approach actually plays right into what research shows women excel at: consistency and patience. It's okay to start small. Many platforms let you invest with as little as $50 or $100. Starting small helps build confidence as you see how it works. Celebrate small wins, like earning dividends or seeing your account tick up with contributions and market gains. Also, don't hesitate to ask questions or seek guidance. There are no dumb questions in investing. If jargon like asset allocation or P/E ratio perplexes you, there are innumerable resources to break them down, and yes, plenty of men don't know this stuff either. They just bluff more often. Taking a beginner investing course or joining a discussion group can demystify things. Sometimes women enjoy learning in group settings where they can share experiences. Consider starting an investment club with friends where you all learn together and maybe each research a company or a fund to present. And importantly, embrace a bit of risk. It might feel safer to keep money in cash, but ironically, playing to safe is risky in another way. You might not grow enough to meet your needs later. A balanced portfolio with some stocks will likely serve you better in the long run than zero stocks. Maybe frame it this way: by investing, you're taking a calculated risk to avoid the bigger risk of not having sufficient funds later. Women are often very good at weighing decisions when given the facts, so once you realize the cost of not investing, you'll see why a moderate risk is warranted. Conclusion: the bottom line is, women absolutely have what it takes to be successful investors. The narrative that women are timid or not good with numbers is outdated nonsense. When women have managed household finances on tight budgets for years, that's financial skill. When women run companies or multitask family and career, that strategic thinking can apply to managing a portfolio too. Confidence often comes from doing. So, to any woman listening who's been sitting on the sidelines, consider this your friendly nudge. Start where you're comfortable, learn as you go, and know that the very qualities you bring to other areas of life planning, caution, diligence, can make you a great investor. And for the men watching, you might even pick up a tip or two from the ladies about patience and prudence. Investing isn't a macho sport. It's a tool for everyone to secure their future. So let's leave the stereotypes behind and make sure everybody, women very much included, feels empowered to grow their sense into big dollars and sensibly build the life they envision.